If you've ever looked at a 401k, an IRA, or a Roth IRA and thought, I should probably understand this better, this is the video. Most people treat retirement accounts like a black box. They throw money in, hope it grows, and pray the IRS doesn't eat half of it later. But here's the truth. The difference between a Roth and a traditional account is not complicated. It's just a timing question. Do you want to pay taxes now? Or do you want to pay taxes later? And if you don't know the answer to that question, the government is going to make it for you. And spoiler alert, they don't pick the option that saves you money. I'm John Conrad, forensic accountant and owner of Numeratus.us. We're the white glove concierge accounting firm helping clients embrace compliance and thrive in the digital age. With decades of experience working in the back offices of successful small, medium-sized businesses, firms, government agencies, and multinational billion-dollar conglomerates, my team and I bridge the gap that holds back entrepreneurs, navigating the turbulent waters of commerce and wealth protection. In this video, I'm going to break down Roth versus traditional retirement accounts in plain English. No jargon, no fluff, just the real mechanics of pre-tax versus post-tax money, what a self-directed IRA actually is, and how the tax consequences hit investors and business owners differently. Let me start with an analogy. I love analogies. Imagine you and the IRS go out to dinner, and at the end of the meal, there's a $100 bill. A traditional retirement account is like saying, I'll pay you later. You eat the meal now, you deduct the cost from your income this year, the IRS says, fine, but when you actually pay me, I'm taking the whole bill, including whatever the tip grew into. So you put in pre-tax dollars. The money grows tax deferred, but when you pull it out in retirement, every dollar, contributions and gains, is taxed as ordinary income. A Roth account is the opposite. You pay the IRS at the door. You pay tax on your income now. Put that after-tax money into the account, and then the growth is yours forever, tax-free. So the question is, do you think your tax rate is higher now or in retirement? If you think it's higher now, you probably want the deduction, traditional. If you think it's going to be higher later, or if you just want certainty, Roth. That's the whole game. Everything else is just mechanics. Let's get specific about investors. Pre-tax money is money you haven't paid income tax on yet. When it goes into a traditional 401k or traditional IRA, it reduces your taxable income today. So if you make $150,000 a year and you put $23,000 into a traditional 401k, the IRS taxes you on $127,000, not $150,000. That's an immediate win on your tax return. But that money is not tax-free. It's tax deferred. The IRS is just waiting. And when you retire and start pulling it out, they take it as ordinary income, not capital gains. That's a big deal because long-term capital gains rates are usually lower. Post-tax money is money you've already paid income tax on. If you put it into a Roth IRA or Roth 401k, there's no deduction today, but the account grows, and qualified withdrawals in retirement are completely tax-free. Here's the blunt version. With a traditional account, you're kicking the can down the road. With a Roth, you're ripping the Band-Aid off now. For a young investor with a low tax rate and decades of compounding ahead, Roth usually wins. For a higher earner in the peak earning years, traditional often makes more sense because the deduction is worth more today. But the real mistake people make is not choosing. They just default into whatever their employer offers and never think about it again. And let's talk about business owners and self-employed people, because this is where it gets interesting. If you own a business, you have more control over your income. You can pay yourself a salary, take distributions, retain earnings in the business, or use pass-through deductions. That flexibility changes the amount. Traditional 401k or SEP IRA gives you a deduction against your business income. That lowers your taxable profit. If your business is having a strong year and you're in a high tax bracket, that deduction can be massive. Here's the catch. You're just deferring the tax. And if your business succeeds and you end up with a higher income in retirement, or if the tax rates go up, you could pay more later than you saved today. Roth strategy is different. You pay the tax now, but you lock in the current tax rate. For business owners who have a lower income year, maybe because they reinvested heavily, had a down year, or took a strategic loss, that could be the perfect window to convert traditional money to Roth or contribute directly to a Roth. This is why tax planning is not a once-a-year thing for business owners. It's a multi-year strategy and discipline. You want to fill up your lower tax brackets with Roth money in the years that you can, and take distributions in the years you're getting hammered. Most people don't do this. They file their taxes, look backward, and wonder why they owe so much. Smart business owners look forward and move money between buckets before December 31st. Let's clear up the confusion between 401ks and IRAs, because people mix these things up all the time. A 401k is an employer-sponsored plan. It has higher contribution limits. In 2025, you could have put $23,500 of your own money into it, plus catch-up contributions if you're over 50. Some employers match your contributions. That match is free money. An IRA is an individual retirement account. You open it yourself. The contribution limit is much lower, $7,000 in 2025 plus a catch-up, but you have more investment flexibility, especially if you use a self-directed IRA. All 401ks and IRAs come in traditional and Roth versions, so you can have a traditional 401k, a Roth 401k, a traditional IRA, or a Roth IRA. The 401k versus IRA part is about who sponsors the account and how much you can put in. The traditional versus Roth part is about when you pay taxes. Here's a rule of thumb. If your employer offers a match, contribute enough to get the full match first. That's 100% return before the market even moves. Then depending on your tax situation, you might max out the 401k or shift additional savings into your IRA or Roth IRA for more control. But don't get romantic about the account type. The account is just a bucket. The tax treatment is what matters. And what the hell is a self-directed IRA? A regular IRA at Fidelity or Vanguard lets you buy stocks, bonds, mutual funds, ETFs. That's it. The menu is quite small. A self-directed IRA is the same tax advantage bucket, but you control what goes into it. You can invest in real estate, private companies, promissory notes, precious metals, cryptocurrency. The tax treatment is the same. You could have a self-directed traditional IRA or a self-directed Roth IRA. The difference is the asset class, not the tax rules. But here's where people get themselves in trouble. The IRS has strict rules about prohibited transactions. You can't use your self-directed IRA to buy a vacation home for yourself. You can't lend money from it to your spouse. You can't run a business inside it that pays you personally. If you break those rules, the entire IRA can be distributed and taxed immediately. And if you're under 59 and a half, you get hit with penalties too. Self-directed IRAs are powerful. They are not a playground. They're for people who understand the asset they're buying and the compliance rules around it. If you want to invest retirement money into real estate or private equity, a self-directed IRA can be a great tool. If you just want to buy Bitcoin because you saw it on X, you're probably doing it wrong. Let's talk about the tax ramifications, because this is where the rubber meets the road. With a traditional account, every dollar you withdraw in retirement is taxed as ordinary income. That means it stacks on top of your Social Security, pension, rental income, business income, everything. It can push you into a higher tax bracket. It can make more of your Social Security taxable. It can increase your Medicare premiums. With a Roth, qualified withdrawals don't show up on your tax return at all. They don't count as income. They don't affect your brackets. They don't trigger any extra taxes on your benefits. That's why Roth money is so valuable in retirement. It gives you optionality. You can pull from traditional accounts in lower income years and Roth accounts in higher income years. You can manage your tax bracket instead of being managed by it. For business owners, this is even more important. If you sell a business, have a big capital gains year, take a large distribution, you can use Roth withdrawals to cover expenses without adding fuel to the fire. And then we have my favorite, the required minimum distributions. And they're a factor. Traditional 401ks and IRAs force you to start pulling money out at a certain age, currently 73, heading to 75. Roth IRAs currently have no RMDs during your lifetime. Roth 401ks now avoid RMDs too. That matters because RMDs can force you to realize income you don't need, which creates tax you didn't plan for. Roth gives you control. Traditional gives you a bill. So how do you actually decide? Ask yourself 3 questions. 1. What is my current tax bracket? And what do I expect it to be in retirement? If it's higher now, maybe lean towards traditional. If it's lower now, maybe lean towards Roth. If you have no idea, split the difference. 2. Do I want flexibility or do I want a deduction today? If you need the deduction to fund the contribution, go traditional. If you can afford to pay the tax now and want full flexibility, maybe Roth. 3. What kind of assets do I want to hold? If you want standard market investments, a regular 401k or IRA is fine. If you want alternative assets like real estate or cryptocurrency, look at a self-directed IRA, but only if you're willing to follow the rules. There is no universal answer right now. The right answer is the one that fits your income trajectory, your business structure, and your retirement plan. And if you don't have a retirement plan, that's a real problem. The account type won't save you if you're not saving. If this video helped you think more clearly about retirement accounts, hit the like button and subscribe. We break down money, taxes, and business strategy without the fluff. If you're a business owner, investor, or self-employed professional trying to build a tax strategy that actually fits your life, that's what we do at Numeratus. Book a call. And if you want a deeper dive into retirement accounts, cryptocurrency regulation, and business structuring, take a look at our videos in our library. Thanks for watching. I'll see you in the next one.